years. So for those of you who've been here before, thank you so much for coming out and enjoying your time. And for those of you who are here for the first time, welcome. Thank you so much for coming out. There's been a lot of work that I've been doing privately to try to make this more automated and more accessible to people, regardless of where they live or what they're doing. I really believe that the information that I'll be sharing and that you'll be learning in this class and future classes will be beneficial to ensuring that you have a better financial future. And you mind if you closing that door? Okay, so for a lot of you, who's this guy? Because I see a lot of new faces, right? So a lot of you is like, who's this guy? Why is he here? Hi, John. And who I am, I'm gonna tell you. So back when I served in the military between 1989 to 1997, flight engineer, had a good time, 47 countries, I had a ball, it was great. When I got in the military, I did very well financially, right out the gate, 6-figure salary, doing well. But as much money as I was able to make, I didn't learn how to protect my money. So when we started having all those economic crashes, 2000, dot-com crash, and then the housing market crash, first time I got hit was 50% loss. And I started out as a day trader. So you can imagine as a day trader, I'm doing well, making tens and tens of thousands of dollars every month, but I didn't know how to protect it. So what ends up happening is we had the dot-com crash, and I was over leveraged with a lot of my investments, and I ended up losing 50% of my portfolio. That's not good. And then it took me years to recover from that. And when I finally get back in 2005, I enjoyed rebuilding for a couple of years, only to lose another 50% in 2008. And if you understand how money works, and the older you get, the less marketable you are, right? A lot of the companies, they don't want to take you because you're getting so old, or maybe a lot of the information that we learned might be obsolete now, right? And I found myself being rendered obsolete more and more every time I ran into a financial crisis. And what ended up happening is after the last financial crisis, I ended up being basically a homeless veteran. And one of the things about being, and gratefully I had family and friends that allowed me to couch surf every now and again. But it really sucks because after you've dedicated so much of your life to this country and you've done so many things for so many people, for you to be rendered homeless is a very uncomfortable thing. So the reason why I'm before you today is because a lot of us, for whatever reason, we made a decision here or there that could have been better, right? But it landed us in a place that we are in transition. And while we're in that transition, it's a perfect opportunity for us to learn some information that's going to be beneficial to making sure that we don't land into that situation again. And one of the things that I learned was the lack of knowledge that you have financially will affect your financial future as well as your future in general. So what I wanted to do here is to be able to offer you information, regardless of whether you're a veteran or not, regardless of whether you're Air Force or not. Who's not Air Force in here? I'm leaving. No. I think you guys should come in. Oh, don't fly away, right? So, regardless of your branch of service, regardless of what your station is in life, this information is essential, I believe, whether you're a young person, old person, male, female, rich or poor, this information has been very beneficial. Now, the last time I was here, we had a class that was very interactive. Everybody was really excited about investing, right? Now, in order for you to get into the position to invest, there are certain things that you must do financially to be prepared, because you understand when you invest money that's in addition to you making sure you take care of your immediate expenses, like your rent, your mortgage, your cell phone bill, gas, whatever living expenses that you have. As long as those expenses are taken, you have a savings and everything else, then whatever you have left over, that can be used for investing so you can grow your wealth, right? Now, we've had a chance to go through a few modules over this year. So because I see so many new faces, I do realize that a lot of the information that was shared before, you might not have had access to, but you will now. Okay, so my goal, before you leave here today, I'm not going to give you a whole bunch of pieces of paper. I'm not going to have you fill out surveys. You don't care about any of that. But what I will ask you to do is get my email address. Because what's going to happen is you're going to have a financial question where you are going to want a detailed answer. Now, can I answer every financial question? Probably not. But between me and my partners, we can pretty much come up with the answer for you that's going to be an actionable answer, because I don't want to just educate you. The whole reason why I'm here is not just to throw a bunch of facts and figures in your face. The reason why I'm here is to give you information that's actionable so you can use it. So wherever you are in your station, you can slowly build from there.
What is your email? What's your email?
Thank you so much for that, right? So, matter of fact, let me write it on the wall.
Before I forget.
I'm not gonna let you forget. You're not my age yet, so you don't have to worry about that memory loss yet.
Oh man. Yeah. Be surprised.
No, I actually wouldn't. So my email address, I guess I could have had a better marker. My email address is info@warfieldlegacy.com. So you can send an email to that anytime. When you send the email, you can ask the question and we can come up with an answer for you that's tailored to your situation. The way that I work with my clients and anybody that I train is I want the information to be tailored specifically to your situation, because if I give you information where I am in my station, it's not going to help you. I'm already an investor. But if you're someone who doesn't even have a checking account yet, I'll be talking right over your head, right? So my goal is to take you from 101 to 901, from A to Z, where you are to where you want to be. Does that make sense? All right. So there, except for those who are Air Force, we're all on the even playing field right now. I'm gonna keep teasing. That's what I do. Okay. So again, the last time I was here, we got really, really interested in the conversation about investing. We were talking about ETFs. We were talking about high yield checking and savings accounts. We were talking about various investment options, right? Does everybody know what a high yield checking or savings account is? Yes? No?
No.
Okay, great. So does everybody know about taxes?
No.
I don't know about taxes. I hire somebody to do mine myself, right? Does everybody know about any type of investment, cryptocurrency or anything like that?
No.
Okay, so you can understand that the information is out there, but if you don't know how to get it, or you might have access to it, but it might not be something that you can understand immediately because it's not your area, right? So you somebody give me a technical job that you had where you don't expect someone else to understand where you're coming from. Who has a history of a technical job? What you got?
Aircraft mechanic.
Aircraft mechanic, right? Okay, I might understand that because I started out as a jet propulsion specialist for the F-111 fighter bomber, right? But tell me something that an aircraft mechanic would know that nobody else knows.
Electricity, engine work. Building with it.
Okay, take your time.
Sorry, got to clear up building with that aircraft mechanic that we did. That a lot of people don't understand.
Right. And it's interesting because everything that he just said, if you were to take a 15-minute class, you would understand it. But if you've never been exposed to that information, how can you be expected to do anything with it, right? And unfortunately, in today's society, we're expected to pay taxes, we're expected to buy and sell things, we're expected to be able to manage our money, budget, and everything. And no one ever taught us any of this stuff. Was it in high school for you? Junior high, college, wherever you were? No. And the reason why that is because they profit off your ignorance, right? Now, one of the things about being a veteran, especially if you're service connected, Fallon, I'm service connected.
Oh, wow, look at you. Finally.
Yes, thank you.
A year later?
It's actually more like 30.
Yeah.
Yeah. So allow me this moment. I'm one of those veterans that believes that other veterans deserve to be taken care of rather than myself, because I left the military in reasonable shape, right? But when I left the military, I got out of the military at 25, felt pretty good. But man, 54 is a B word. I'm telling you. And a lot of the things that I went through in the military actually exacerbated as I got older. And I'm like, you know what? I think I need some help right now. So yeah, I finally got service connected. You know, I'm not 100% yet, but give me some time. I'm gonna get that money, especially with those raises that they're getting. So again, last time we had a chance to have a conversation, we were talking about investing. So I wanted to be able to grab a couple of things that I thought were very important and be able to show you some of this information. Now, the information I'm going to be sharing is with the American College of Financial Services, right? For people like me, this is, you know, where I get my training and everything, but I wanted to be able to share this information because it's laid out in a very clear way. And what's great about that is when you send me an email for whatever question you might have, I can just send you this video easy peasy, not even 30 seconds later. It's great. So let's go ahead and take a look at a couple of these and then talk about it. Can we do that? Excellent. I'm gonna click on this one first, if it allows. Hopefully it's loud enough.
Investing is the act of allocating resources, usually money, with the expectation of generating income or profit. Why is it important? Investing helps you achieve goals, financial security, and take control of your financial future. You work hard for your money, and your money should work hard for you. Active income is the money you physically work for, like your 9-to-5 job. Passive income is money that is accumulated over time without you physically working for it. Essentially, your money makes money for you. Over time, saving can build up money. However, investing offers the best way to achieve long-term financial goals. A discussion of investing must begin with the truth. Investing means taking risks. Investment success depends in part on the ability to address those risks without passing up reasonable returns. There are risks with not investing your money as well. Did you know that your money loses value at average 2% every year? This means $100 today would have spending power of only $98 next year on average because of inflation. Depending on how long you're going to be invested, you can afford to take on more risk. For example, if you're saving for a down payment on a home and you will need the funds in the next 18 months, you would want to invest in something low risk, perhaps a bond. If you are saving money for retirement and you have 30 years to invest, you can afford to invest more aggressively. The risk of your investments depend on the mix of investments within your account or portfolio. When you determine what is in your portfolio, you may also determine how often you want to trade your stocks and bonds. Trading costs money, and excessive trade is not generally profitable for novice investors. Active investment is when investors actively buy and sell investments to make more money, sometimes called day trading. There is nothing inherently good or bad about day trading, but it does come with substantial risk and should not be engaged in unless you know what you are doing. Passive investing is when you determine your risk tolerance and the time you want to invest in the market. Select a diverse portfolio and automate ongoing deposits. This is also called buy and hold investing. In comparisons, passively managed funds outperform actively managed funds in the long run. We are all about holistic and sustainable plans, and investing is not a get rich quick plan. It's a grow your wealth slowly.
All right, so I want to be able to translate what you just heard to your current situation right now, right? Whether you're here for a month, whether you're here for a year, whatever your time is, do you have an income while you're here? Show of hands, do you have an income while you're here? Okay, is your income service connected? You have one? Okay, is your income, let me take a back step. Does your income cover all your expenses right now?
Yeah.
At the end of the month, do you have any money left over after all your expenses are paid?
Little bit like this.
Little bit.
Okay. Now we're gonna get into some trouble. Okay, so let's have this conversation because this is what I want. This is where I want to go. If you have money left over at the end of the month, that is a discretionary income that you can use for whatever you want, right? Now, your discretionary income, if you don't have an emergency fund, your discretionary income, if you don't have a savings, means that you need to be shifting that money into an emergency fund and a savings, right? Now, this is what's very important about this particular situation we're in right now, okay? Does anybody plan on staying here forever? No, right? So the goal is once we get out of here, we're gonna stay out here, right? So that means that whatever monies that we're generating, that money needs to make sure it's protecting us from going backwards, right? So let me talk about your discretionary income. Again, a show of hands, how many people who have money left over at the end of the month? Okay. The people who don't have money left over at the end of the month, is it because of your needed expenses, your cell phone, what it's something that you actually need that you're paying for? Or is it because your spending habits, and you don't have to answer this is rhetorical, or is it because your spending habits need to be adjusted? Give you an example, right? I really love watches. Do I need 30 watches? How many arms do I have? I'm left-handed, so that sounds like I only need one watch on my left hand. I don't need the other 29 watches. But as soon as I see a watch, a shiny watch in the window somewhere, I'm gonna go in there and I'm gonna ask them about this watch and I'm gonna see how much that watch costs. I know I don't need that watch, but if I pay X number of dollars for that watch and I don't need it, that money could have been allocated for something more productive. Perhaps something that I might need later on down the road, right? So if you don't have money available at the end of the month, and that money is because you like watches or you like X, you like this, that, or whatever, if your spending does not allow you to have money at the end of the month, we need to adjust our spending habits. And you'll be surprised. I had a friend of mine, one of my clients, he wanted a life insurance policy. I'm a licensed life insurance agent. He wanted a life insurance policy, but he did not want to pay the premiums for it. And I said, what if I can get you to pay the premium without having to pay any additional money? He said, how are you gonna do that? I said, you like coffee, don't you? He says, yes. So I said, how often do you go to Starbucks? Every day. Does he have to have Starbucks every day?
Yeah.
I ain't gonna even lie, right? Some people will say yes, right? Now, the question was, does he have to have Starbucks? It wasn't, does he have to have coffee? You notice the difference? Because some people really cannot function without their coffee, but it doesn't matter where he gets the coffee from. So I told him, why don't you invest in a Keurig? And you can buy Starbucks coffee brand for your Keurig. The money that he saved monthly by buying that Keurig covered the cost of his life insurance policy, and he doesn't have to pay anything more. So what I taught him to do was reallocate what he's already spending into something more productive, right? So whatever you're spending your money on, let's take a look at what those expenses are, right? If it's something that you can shift to something more productive, then you can start generating a discretionary income, and then the information that we just learned here can start being utilized. Does that make sense? All right, great. So, Fallon, why is this thing not like me?
Because you let it sleep.
I gotta stop doing it, right?
Versus it.
My woman don't let me sleep.
Investing is the act of allocating resources, using money.
All right, so let's talk about stocks, bonds, and mutual funds and ETFs. Now, an ETF is something that I was using, but for some reason I could never figure out what it was about. So this is, last time we had the class, we had a lot of questions about individual types of investing. Once we get through with a couple of these videos, you're gonna understand where I'm going with this for you. Okay, so let's watch this as well. Can y'all hear this okay?
Investing is the next most common way to increase assets and accomplish large financial goals, such as retirement or a child's education. The stock market also provides a way to protect assets from inflation or the rising cost of living over time. But what do we mean by investing? And what are all the different investment vehicles? Investment options include stocks, bonds, mutual funds, and exchange-traded funds as the basic groups. Let's dive into stocks and bonds first. Stocks are equity investments, which represent ownership interest in a company. Equity in the company is sold to investors. The The company uses those funds to grow their business, which creates profits for the company and increases value of the stock, therefore growing as an asset for the investor. Unlike gambling, where money is exchanged for a small chance at a reward and a large chance at a loss, investing in the stock market exchanges cash for future growth in a company with real products, services, and value. The stock market has fluctuated over its history, but it has consistently outperformed other investment vehicles. There are two major types of stocks. They are common stocks and preferred stocks. A common stock is ownership in a publicly traded company. Shareholders are entitled to vote in the election of company officers, as well as other important matters, and they often receive dividends, which are gains on the shares they own. Among common stocks, there are blue chip stocks, which have a long history, generally 25 years or more. They consistently make dividend payments and have a relatively stable value. Think of Coca-Cola or IBM. They are well established and financially sound, with a dependable track record of sales and growth. Growth stocks have a short history and are thought for their potential for increase as the company's market value goes up. Tech startups that go public, such as Facebook or Twitter, would fall into this category of common stock. Preferred stocks are a class of stocks that have a claim on the company's earnings before common stockholders, in the case of dividend, consolidation, or liquidation of the company. Preferred shareholders do not usually have voting rights, but do receive a fixed dividend before common stockholders. Because of the increased security and dividend income generated by preferred stocks, they behave as a hybrid between a stock and a bond. And what is a bond? A bond is an IOU. When investors buy a bond, they loan money to a publicly traded company, which is a corporate bond, or a governmental entity, which is a municipal bond for a fixed period of time. In return, the company or governmental entity promises to repay the amount borrowed, plus interest. Much like other loans, the interest payments or coupon payments are set at sale of the bond and stay the same across the life of the bond. Bonds provide a predictable and stable income stream and a known return on the investment. Also, unlike stocks, which represent ownership in a company, bonds are a legally binding loan between an entity and an investor and are recorded on their books. In the event that an issuing entity goes out of business, their assets will be sold off and used to pay their creditors, including those investors who purchase bonds. There are several issues with trying to purchase stocks or bonds as a new investor. The first issue is that a single stock can be expensive depending on the company. Go look online at the price of a single stock in your favorite companies. And the job of deciding which companies to invest in is no small feat. The bond market is similarly complex and difficult for the average person to navigate as a new investor. In addition, when it comes time to build an investment portfolio, you have to consider which stocks and bonds suit your goals as the investor, as well as your comfort with risk and your goals through proper portfolio diversification. Diversification is the old idea not to put all your eggs in one basket. By heavily investing in single companies, the average investor is risking a large percentage of their entire investment portfolio or retirement savings on the success of that company. Diversification is the process of investing in the success of the entire market or a group of companies, rather than in individual companies or stocks. A mutual fund is an investment that pools the money of a large group of investors in a large group of stocks and bonds. Mutual fund companies are management companies. Mutual funds connect investors to the stock market by packaging a diversified portfolio and handling the process of distributing dividends and capital gains from the pooled assets back to the individual investors. Mutual funds offer diversification, professional management, liquidity, easily sell and cash out shares, and simplicity for investors. Mutual funds can only be bought or sold at the close of the market for their net asset value or closing price. Exchange-traded funds, or ETFs, function the same way as mutual funds, but can be traded throughout the day like a stock or bond. When you select a mutual fund or exchange-traded fund, pay attention to the fees. When it comes to investing, more expensive funds do not offer you a higher return. You want to pay as little as you can in fees. Keep your hard-earned money. Stay tuned for more information on investing and how to move from knowledge to action in your journey to become becoming a savvy investor.
All right, so let me go ahead and help y'all understand why I decided to share these particular videos, right? So let's talk about where we are right now. Again, whether you're here for a month, whether you're here for a year or whatever, right? You have an income, yes? Do you have to pay to stay here?
Yes.
How much does it cost to stay here?
Depends.
Depends, right? Whatever you have to pay to stay here, once you make that payment, the money that you have left over is doing what for you? What is it, how's it working for you?
Oh, no, it should be.
Okay, so today I just showed you, we talked about bonds, we talked about ETFs, stocks, we talked about checking accounts, high yield checking accounts, right? So there's a hierarchy with these different types of accounts, you understand that? So what is the lowest return that you get? Which account offers the lowest return over time? Does anybody know?
The savings account.
Savings account, exactly. What is the average return that you get on a savings account?
0.0.
You've been to my class, you're cheating, right? That's exactly right, about 0.2 at best, right? Now, why is a savings account a good thing to have?
In case you need money,
They ain't doing so great today, if nobody knows that, right? Why is that?
in case you need money.
In case you need money, right? It's for the liquidity. If you need access to your money, a checking or a savings account is a fabulous account. It's gonna allow you to get access to your money, ATM card, whatever, because you need your money right now, okay? Let's talk about, maybe I need my money to be more liquid, but maybe I wanna be able to outpace inflation, because what did they say the average inflation was right now, 1.82%? Exactly, right? So again, what is the average savings account offering right now? And what is inflation right now? So is inflation higher than what you're getting from your savings account?
You lose money.
You're losing money, right? If you're losing money in that savings account, why the hell is the money in there? Right? Especially when they're offering accounts that offer interest rates that are higher than the inflation rate. Now, some of these accounts do require you to have a minimum balance. Some of them might be zero, some of them might be $500, some of them might be $5,000. Now, the more money that they're saying is the minimum balance, the higher the high interest that they're going to offer you. I've seen them get as high as 4.85%. So you'll be earning, and comparatively to your inflation, about 2.85%. That means your money is growing while it's sitting in the savings account. So any unused money in your savings account is growing. That's what we want, right? Now, I'm saying this to you for this reason. If you're here for, and I said this before, if you're here for a month or you're here for a year or however long you're here, this is an opportunity for you to learn some basic financial concepts while you're stable. And while you're stable, the money that you're saving, if you don't need the discretionary income for anything that's dire, like you got an emergency or something like that, if that money or any money that you could be reallocating into something that's going to be more productive or more conducive to your financial future, if you can put that money and save that money while you're here in a stable situation, your financial situation when you do leave here will be better than when you got here. Does that make sense? So let's talk about what's next after. So we started out with a savings account, 0.2.
I got a
Yes.
question on savings account. When you first go to open a new savings account, say today, do you like negotiate with the bank about what type of interest rate you want? You probably went over this, like how much you're gonna get back on the money you're gonna put in. I'm sure you went over this before I got it back in here.
You got no idea how much of a fantastic question that is. The answer is yes, but the real answer is depends on,
Okay.
right? Okay, so let's say your income, your annual income is $40,000 a year. Can you negotiate your interest?
Probably,
No,
no?
you don't make enough money, they ain't look at you.
Oh, really?
But if I walked into that bank with $500 million and I said, look, we need to have a conversation, right?
Right.
They're gonna see that $500 million. And some companies like Charles Schwab won't even look at you if you got less than $500,000. But the more money that you have, the more buying power you have, the more purchasing power, but the more power you have, the more negotiation power. You are absolutely right. You can negotiate the interest that you get, but in order for you to be able to get that kind of love from any financial institution, it has to be money that they want, right? So when you look at a savings account, right? What is the problem with a savings account? What is the problem with a checking account when it comes to a bank? Do you know?
Fees.
Fees on your side. But how does a bank feel about your checking and savings account?
They want money in it.
They do want money in it, but what is their problem with it?
You earn interest.
You're earning interest, but what is their problem with it?
You take away.
It's too accessible.
It's too accessible. They don't like that you can come and take that money out anytime you want. Because remember, the bank, the second you put your money into that bank, they're already, literally the second you put that money into the bank, it's already going out to give someone else a loan. Now, what's so interesting about this is they're giving you 0.2%, but they're charging people to borrow your money that you just put into this bank as much as 36% for that loan. That's a pretty bad credit, by the way. But they can charge that. The second you put that money in. Now, this is why they don't like you. Because guess who has priority over your money whenever you need your money? They don't. You do. They have to give you your money. So what ends up happening is, say you have X number of dollars in your account, and you want to take that money out. That money is already somewhere working, right? So the second you take a withdrawal, they literally have to take that money from somewhere else to give it to you. Now, this is a bank that's worth billions of dollars. This is not specifically just you, but you know you have all this money being deposited and debited from accounts all day by millions of people every day. So they actually have to take that money from other investments to give you your cash, right? They don't want to do that. They want to be able to keep that money going over, because what ends up happening is they take your money, right? And they actually turn your money over as much as 10 times after you put a deposit in there. So your $100 to them, when they loan it to someone else, this is messed up when I tell you this, right? You got $100. You put your $100 into your account. Someone gets a loan. They get that $100 that you just put in there. They take that $100 loan and they do what? They put that $100 loan into their checking account. Now the bank is going to be, you understand what I'm saying?
They're leveraging.
They're going to be, and this keeps going on and on and on and on and on. So the bank is literally making 10 different transactions off of every dollar that you put into that bank. And they're charging people to borrow. You can be borrowing money from that same bank at an interest rate as much as 36%. But if you have money in that bank, you're making, how much is that again? 0.2%? Yeah. That's unequal. So that's why we need to start thinking like the banks. Where can we start putting our money in there? What accounts or what types of accounts can we start putting our money in that's going to get us better returns? But before we can ask that question, we need to figure out what this money is for. That's why we were looking at these videos today. What is the money for? If you have money coming into your checking account every month and you're taking care of all your business and you have a discretionary account or a discretionary amount of money left over, what are you using that money for? You want to build an emergency fund. Tony, what is an emergency fund? If you were to lose your income, how long can you survive before that income comes back? You want at least 3 to 6 months of whatever your general monthly expenses are, right? Once you have that saved, then you want to start having a savings account. And the savings account has to be someplace that's not accessible to you. Because let me tell you what happens with money that's accessible to you. Everything becomes an emergency. You understand that? Let me get in trouble. So Bulova has this green watch that I really like, right? This green watch was $785, right? I make sure there's no money that will pay for a watch in my account. because for some reason that it seemed like an emergency that I needed to get this watch, right? I'm like, my favorite color is emerald, dark emerald. This was a dark emerald Bulova watch. You know how many ladies would be, just in case y'all watching, you know how many ladies would check that watch out? It's beautiful, but is it an emergency? No. So I can't buy it because it's not in my account. That money is somewhere working for me, so when there is an actual emergency, I can pay for that. Because what was the biggest emergency that we had in recent years? COVID. What are the two biggest products that people fought over during COVID? Does anybody know?
Toilet paper.
Toilet paper, what's the other one?
Sanitizer.
No, actually.
Water.
Huh?
Water.
No, actually. It'll trip you out. It is the craziest thing. Lysol.
Oh, yeah.
Lysol. When you say the hand sanitizer, it was true, but Lysol, people were freaking out, and Lysol is a trusted product. And for some reason, Lysol went from $2.39 a can to $7.99 a can, so you couldn't even access it unless you went on Amazon or something. That was a true emergency. So if you spent all your money on Bulova watches, you wouldn't be able to do that thing with the bear, right? The Charmin bear, is it, right? Or you wouldn't be able to spray. You'll be a flashy sick person because you don't have any money, right? So we need to make sure that the money is put in an account that's going to be beneficial to our financial future. If we need money right now, absolutely put it in that checking and savings account. But if that money does not need to be used right now, let's start talking about places that we can put it that's going to help us earn interest that outpaces inflation, right? So that's when we start looking at the high yield checking and savings accounts. We start looking at, does anybody know what a bond is? We just talked about a bond, right? That's a loan that you're giving whatever company or even the United States. You're loaning them your money, and they're promising you, it's an IOU, they're promising you that they're going to give you your money back, plus a set amount of interest over a certain period of time. There's another product that banks offer, it's called a certificate of deposit, right? That's something that you might be interested in. So, but in order for you to use a certificate of deposit, that CD could be 3 months, it could be 6 months, it could be a year, 2, 5 years, right? But in order for you to be able to benefit from the interest from that account is you have to leave the money in that account for the duration that you said you will leave that money in the account. Otherwise, they cannot guarantee you the return because you took the money out too soon. We can start talking about mutual funds. The young lady, she mentioned that you don't want to put all your eggs in one basket, right? We had a very, very savvy veteran that was here last time. I'm not going to tell you his name. If you're watching, I think it's call sign. What was his call sign? Magic Man. Magic Man, this is for you. This bud's for you. So Magic Man was actually investing in one stock that did very well. I was very proud of him. But if you invest in one stock and that one stock crashes, what happens to your money? It goes bye-bye, right? Now, does everybody understand how the stock market works when it comes to your money? Say you had $100, right? You got $100, and the stock market goes up 50%. How much money is in your account?
150.
150. If the stock market drops 50%, how much money do you have in your account now?
$50.
Well, you just had 150.
Oh,
So what's 50% of $75? If the market goes up 50%, how much money do you have in your account?
125. No,
180.
135.
From 75 plus 50% equals what?
125.
180.
Anybody else? What's 50% of 75?
37.
37 and a half, right? Plus the 75 will be $102.50, right? So a lot of people think that, hey, the market has to go up exactly what it went down. No, it's the percentage that they're calculating it by is by how much money that you have in your account, not how much money you had, right? So if you understand the stock market and you are not able to handle the potential loss of your money, you need to start putting your money into more secure accounts. So that's why there's a hierarchy. Savings account, high yield savings account, certificate of deposit, bonds, mutual funds, stock market, right? When you start putting your money into the stock market, that means if that money were to be lost altogether, you are not in a worse financial situation. So what? It happens, right? But if you can put yourself in a situation where you have something more secure, something that's going to give you like a 5% return, 8% return. Are you earning 8% on your checking or savings account right now?
No.
No. If you're going to be here for a year, let's throw this at you, right? If you're going to be here for a year and you're only able to save $20 a month, at the end of the year, you got $240. That $240 is earning in percent. Divide 8% by 12%. I'm not going to bore you with that. But by the end of the year, that $240 plus your compounding interest means you're going to have better, closer to $300, right? Not a whole lot of money, but that $300 at the end of the year is going to jive with your buying power from the previous year. Tony, what are you talking about? So remember, because inflation is averaging about 2% a year, your $100 today, this day next year is only going to be worth how much? $98. $98. So you need to make sure that your money is at least keeping up with inflation. It's not doing that in your savings account. So you got to put your money somewhere else, because everything, and this is what people don't understand. Everything is not becoming more expensive. It's not. Everything is exactly the same. It's just that it takes more dollars to get it. Why? Tell me, that doesn't make any sense. Yeah, it does. Because the dollar itself is getting weaker every year, so it requires more for you to get the same products and services that you were getting the year prior, right? That's what inflation is. So in order for you to be able to keep up with that, the money has to be in an account that's going to allow you to do that. So let's talk about that discretionary income one more time. Again, a show of hands on how many people who have money left over at the end of the month? Okay. Rhetorical question. What do you do with it? I want you to think about that question. So when you leave here, I want you to think about that, because here's the deal. I'm gonna get in trouble. Please don't hurt me when I ask this question. If you don't have, how do I say this? So that money that you have at the end of the month, if you don't have at least 6 months of that amount at the end of the year, what are you doing with your money? Now, I didn't say 12 months. Say you have $50 at the end of the month every month, right? $50 at the end of the month every month. By the end of the year, you should have about $600, right? That's not likely. Stuff happens, but you should at least have $300, right? If you don't have at least $300, what are you doing with your money? Okay, you're actually going backwards. And the reason why this is important, particularly for the people in this room, in order for you to go through what you're going through right now, whether you realize it or not, this is a blessing. One of the things about me sitting on my mother's couch for a couple of years, it's a very humbling experience, especially because my mother was a Virgo. She was mean, y'all. She was mean. My mother was mean. She would get up every day and tell me to get my ass up. So I would get up before she would get up, so I didn't have to hear my mother telling me to get my ass up, right? Now, the one thing about a Black woman, when she's sick and tired of seeing you, she gonna make sure you know she's sick and tired of seeing you, right? So the great thing about what she did is that experience was so uncomfortable that I made sure that I would never have to go through that experience again, right? So how do I do that? A lot of the practices that I'm doing have to be modified to make sure that the stations that I'm at, that I'm uncomfortable in, I don't have to return to. Does that make sense? So again, those of you that have a discretionary income, I want you to start looking at what you're doing with the extra money that you have at the end of the month, and see if you can reallocate those funds into something more productive, even if you only try it for just 1 month, maybe 2 months, maybe 3. Because what you're gonna find is if you do something, what is it, for 14 times in a row? Once you start doing something repetitively, it becomes a habit. Muscle memory, right? If you're not using that money, right? Does anybody know about paying yourself? Show of hands if anybody knows about paying yourself. What's paying yourself? 10%? Okay, what's paying yourself?
To, what was your income to set aside money for yourself, a percentage?
That's actually right.
20%.
So does anybody remember what a paycheck looks like? Y'all see all these acronyms? Now, if you're military, we see acronyms all the time, right? And they're not always to our benefit, right? You see all those acronyms. Every one of those acronyms, when do they get your money?
Before it gets you.
Before you do. Right? They get your money. I didn't see you on that line. I didn't see you in that plane. I didn't see you, on that jet engine line. I didn't see you. You weren't working with me. You didn't pick up a wrench, but yet you get half my money before I get my check. Right? So and then what's so messed up about it is when you get your check, then you got to worry about paying Verizon, landlord. Who else? Who else? Shell, whoever. You got to pay all these people, and then at the end of the day, when you want some money available for you, you done paid all these. Another acronym is MF. Does everybody know what the acronym MF is? We're not Amish in here, are we? All right, you know what MF stands for, right?
Most feared, most feared.
Most feared. Yes, that's a brilliant guy right there. Yes, I'm most feared as well when it comes to that. So you got to pay all these people, but you never pay yourself. And then what ends up happening when you want to go on a vacation? What ends up happening when you want to buy a watch? What ends up happening when you just want to sit at home and chill? What ends up happening when you want to buy your girl something nice? What's happening when you want to buy your kids something? You don't have the money available because you didn't take the time to pay yourself, right? Well, paying yourself also includes making sure that the money that you are not necessarily allocating for something productive to your financial future can be reallocated into something that is, right? It's essential that you understand that because we want to go from where we are to where we want to be. The next rhetorical question I'm going to ask you is, where do you want to be?
Financially stable.
Financially stable, right? What does since you're willing to share, what does financial stability look like to you?
Money in the bank, money in my pocket, money I can use for emergencies.
That's exactly right. Okay. Now, if you're not, can you state that one a little bit? You're not on camera, so can you say that a little bit louder?
Money in the bank, money for emergencies, and money in your pocket.
Okay. So if you don't have all three of those right now, and you have a discretionary income, what do you do with that discretionary income?
That would go into the bank.
Okay. Now, once it's in the bank, what is it doing in the bank? Is it just there to be as a holding place
I
for
put
you?
it in the savings account, so it's drawing interest.
Okay. Okay. When do you plan on using that money? I'm loving him right now. When do you plan on using that money? Is it something that you're gonna have to use next month?
No.
When are you gonna use it?
Hopefully I won't have to.
Now, if you don't know if you're gonna be using that money anytime soon, probably a year or so, but now, because you're not gonna be using that money for a while, do you put it in a regular savings account?
No, that's the time you can start looking at the stock market or different areas of the stock market.
Okay.
And
That's great. That's a great answer. Now, again, let's be careful because this is a perfect point, right? He's exactly right, except for there was one caveat in my question. If you don't have those three things that you mentioned, the stock market is not where you want your money to go.
no, you want a stable market.
You want a stable market. So which accounts offer a stable return?
Bonds.
Let me hear it.
Bonds.
Bonds, that's one. What's another one?
ETFs.
No, that's still stocks. High yield checking and savings accounts, right? These are accounts that's going to give you a positive return regardless of whatever the market's doing, right? Fantastic answer, sir. And this is why, okay, you just got to do it. So this is why this is important, right? If you don't have yourself in a secure position, you don't want to put your money in an unsecured account. That makes sense? The stock market will give you great returns, but it also has the potential to
Put you right back.
put you right back, actually put you in a minus. It can actually take everything from you. Fantastic answers, sir. So, does anybody have any questions on that? How am I doing on time, fella?
I think you have to 12:30.
Everybody's
Let's see
following.
if you can touch on compound interest.
Compounding interest. Okay, so compounding interest, we were kind of indirectly talking about compounding interest this whole time. So let's talk about two types of interest. You have what is called simple interest, and you have what is called compounding interest. Which one do you think the bank is giving you?
Simple.
Simple.
Yeah, you ain't making no money up in there. Right. So simple interest is earning
What you
interest.
see is what you get.
What you see is what you get. Simple interest is earning interest on the principal of your money. So say I have $100 in my account. I got $100 on my account, and I'm earning 10%. How much money do I have at the end of the year?
110.
$110. Okay, I'm still earning 10% that second year, but how much money do I have at the end of the second year?
With simple
With
interest,
simple interest.
it'd be 120.
God, what's your name? No, what's your call sign?
We didn't go to that.
What's your call sign then? Give me something.
Lightning.
Oh. You said lightning, a little thunder, a little lightning.
Yeah,
The rundown, Mr. Rocky. I like the movie.
yeah.
Don't judge me. All right. Okay. All right. Lightning. That's a fantastic answer, and you answered it like lightning as well. So simple interest. The answer, yes, is $120 because you're earning $10 every year on the $100 principal. Right. It's going to take you forever to earn money on that. Right. Then there's compounding interest. Lightning. So let's say that you earn 10% compounding interest that first year. After the first year, how much money do you have?
110.
After the second year, how much money do you have?
121.
Man, this guy, I gotta somebody paying attention. All right.
Don't get that.
That's my
Don't
fault.
get
Don't get zapped.
Lightning.
Well, you understand my name is Warhead, right? You know why they call me Warhead?
I know, I was assuming it was like, maybe the pilot is called sign.
No, they call me Warhead because I'm the bomb.
All right.
Warhead on the forehead.
Joanne's big.
That, you ever been to Sears store?
Say it.
You ever go through Sears
Of
store?
course. Are you kidding?
That's me.
You went to
I
Sears
was an
school?
instructor. No,
You were an instructor? Were you the one that put me in that little box?
me.
All right, can y'all allow me a little bit of levity? All right, so they shoved my, well, then I was about 100 pounds lighter. Sandwiches
Well,
are
we
delicious.
just won your side.
Hey man, you kinda like Kobe Bryant, man.
No, he looks like me, right? Say, everybody says that 2020, all this, but I don't have any money, so I guess. So they shoved me into this box, right? Now the box never moved, because y'all didn't trick us. The box never moved, but they put a crank on the outside of it to make it sound like the box is getting smaller. So I'm literally finding myself squeezing myself down. The box is not moving. I got all this air in here, but I'm still squeezing myself down smaller. SEER training sucked. But do you know the worst part of SEER training?
The waterboard.
Nope.
Besides that, no. Probably-
Waterboarding sucks, by the way. But that
Yes,
wasn't the worst.
Yes, it does. Isolation.
Nope.
What is waterboarding? Is that what it looks like?
No food.
Close.
Put the rag over your
They
face?
put the rag on your face and pour water on it. Yeah. Now I want you to hear what I'm saying. The fear of drowning and the sensation of drowning is terrible. But what's worse than that is what I'm about to tell you. What's worse than that? What did you say it was, John?
No food.
No food? No, it was the food.
Oh, yeah, that's.
They had,
Well, one-stop shopping with food, it was.
Already chewed.
it had to be that. So we, in the military Air Force, we had this thing called a grog bowl, right? A toilet that had like candy bars and everything, but it's supposed to look like crap, right? Well, in SEER training, it really was crap. It was like pasta, beans, and some kind of I swear to, I really thought you guys were standing in a circle peeing in this coffee for no reason. It was terrible.
We made you think that.
You know what? It worked too. But you see where I'm standing, right? I still flew, so obviously I went through it. But I ain't going through it again. But anywho, so let me find my point. Compounding interest, right? So yes, the answer is 121. Compounding interest is you're earning interest on the principal and you're earning interest on the interest from the prior year. Okay, now, compounding interest can be your friend or it can be your foe. For most people, what is compounding? The relationship that people have with compounding interest on average, is it a friend or is it a foe?
Well,
Who says friend?
I say both.
Okay, who says foe? It's a foe. Why is it a foe?
it's probably on the bank that's giving you the loan, or whoever, if you have a loan, they're charging you interest, compound interest.
Now that's actually a great answer, but the proper answer is lack of knowledge. If everybody knew what compounding interest really was and the power of compounding interest, you would make it your friend and stop making it your foe. Tony, what you're talking about? We've been talking about that this whole time. Because what is inflation? It's interest, right? They're charging you 2% on your money every year on average, right? Your checking account is making how much? 0.2%. So your checking account is not giving you anything, and the United States is taking everything. So when do you actually get to earn any money? You have to start putting your money into accounts that's going to be able to outpace that inflation. So how do you make compounding interest your friend? First, you got to understand it. And then once you understand it, you'll start finding the accounts that offer you better rates. That's what we've been talking about. We've been talking about mutual funds. We've been talking about high yield checking accounts. We've been talking about ETFs. We've been talking about stocks, right? These are places that your money will sit and earn you more money without you working for it. That's called passive income, right? Now, I was going to go over taxation, but I'm not going to bore you with that. But you understand that anytime you're earning money in the stock market, I'm gonna mess you up with this because this is true, right? Anytime you're earning money in the stock market, even though that's passive income, you still have to pay taxes on it.
Yes.
Now, who said that? What are capital gains?
Paid on basically how much you made in the stock market.
Okay, what is the maximum capital gains rate? This is gonna sound messed up when y'all hear this. Maximum.
It's like 4%.
The maximum capital gains rate that you will ever pay is 20%.
20.
20%. What is the maximum income tax rate? The money that you work for, by the way. What's the maximum?
Be up to 32, 34.
37%.
37.
Now pay attention. This is why we're doing this class. If the capital gains rate maximum is 20% and the working rate is 37%, who are the people that do the most investing?
Rich people.
Rich people, or people who have the discretionary income to invest. So the people who have the most money are the people who pay legally the least taxes. And it's because of the knowledge that they have. Now, these same people are the same people who hire lobbyists to make sure that the tax rates benefit them so they can keep more of their money while they're taking all of your money. That's why the biggest tax increases are going to affect the middle class starting January 1st. So again, I ask you, what type of relationship do you want to have with compounding interest? Because when it comes to your taxation, you're going to want more of your money being passive and less of your money being worked on so you can pay less taxes. Now, there are several tax credits that you might be eligible for in 2026, even though that so-called, well, I'm not going to say it, but that bill that they're coming out with, it's got some benefits depending on how much money you have. But we want to understand how we can take advantage of these different tax benefits that they're offering to pretty much everyone who qualifies, but you just have to be able to qualify. Now, you might not qualify for that $500,000 or that $1 million or whatever, but you can put your money in a better financial situation that you can build upon, right? Because you have a stable living situation here right now, this is an opportunity for you to start looking at allocating some of your additional funds, or even looking at some of your current spending and potentially allocating some of that into something that's going to help you grow more money for later, right? And one of the best things to do is to have a goal for that money. Okay, so this is a rhetorical question, but I want you to answer this question to yourself before you leave. Okay, what is it that I want short term? This is for you too. This is for you too. What is it that I want short term that I have enough money at the end of the month that I can save to be able to get that thing that I want in this much time? Okay, let me give you an idea of what I'm saying, right? I really love that watch. That watch is $785. So if I have a monthly discretionary income of $150, I'm not gonna be able to save $150 a month because that's all I got, right? But it is conceivable that I can save $50, maybe $75. Maybe even $100. I still got $50 for my pocket, right? So if I can save $100 every month, and that's my average discretionary income, in order for me to get that $785 watch, which is actually $857 after taxes, how many months do I need to save that $100 before I get my watch? 9 months, right? But I saved that money for 9 months. Now, what ends up happening at the end of the 9 months is going to be very interesting to you, right? I'm going somewhere with this. I really wanted that watch 9 months ago. But what happens 9 months from now? Christmas.
A new version came out.
A new version came out. Something happened to where now you're starting to look at, maybe I don't need that watch because I'd rather have that. Well, whatever that is, it might be more than what you got. And what's interesting about this is where this gets exciting, right? Whatever it is that you want now, after that 9 months that you saved for that watch, whatever it is that you want now might not manifest for you for another couple of years. So now you got $900 and you need to save for another 2 years for this new thing that you want. Where do you put that $900?
In the bank, drawing interest.
Which bank?
Your savings account, withdrawing account.
Okay.
Credit union.
Credit union, okay.
Credit union.
So let me ask you this question. If you know, there's a reason why I kept saying 2 years. If you know you're not going to use that money because it's important,
Once on the account.
yes. But what type of an account is going to allow you to put that money away for 2 years and keep you from accessing it? Because whatever it is that's important to you, you don't want to be using this money. You don't want that money accessible.
CD.
Say it louder.
CD.
You put the money into a certificate of deposit.
Yeah.
Now that certificate of deposit is going to be a 2-year CD that's going to offer you 4.4%, which is better than what you're making in a standard savings account. The money is not accessible to you, so you don't have to worry about taking that money out for some frivolous emergency situation. So at the end of that 2 years, that $900 just earned 4.4% for 2 years. So now your $900 is looking more like $1,050, right?
Right.
Maybe a little bit more, right? But the purpose of this discussion is, what did that money do while it was away from you? It worked. It worked for you. And now that $1,050 can be used for whatever you want it for. Now I'm gonna ask you another silly question. What happens is once that CD matures, and now you have something else that you want? Because $1,000 right now, where would $1,000, if you had $1,000 extra right now, what would you use that $1,000 for? This is rhetorical, okay? Because what's gonna end up happening is, say you're here for a year, and once you leave here, wherever you're gonna go, Would that $1,000 be the difference between you having groceries or not? Would that $1,000 be the difference between you being able to put a down payment on a vehicle, maybe?
No.
Right? That $1,000 can be used for something that's going to help you do what? That's the question. What is that $1,000 going to help you do? If you get a job, do you want to use all that $1,000 on Lyft and Uber?
Not going to compound it over.
You want to do something, but my point being is that $1,000, because that $1,000 was working for you before and earned interest. If you take that $1,000 out, you want that $1,000 to continue working for you, right?
Right.
How can that $1,000 continue working for you if you take it out of the bank?
Reinvest it.
In what?
High yield percentage.
Another CD.
I need you to think bigger. How about investing in you? Because when you get out of here, you're gonna need a job, right?
No.
I don't care if you're service connected or not. You're gonna want to have some kind of extra money being produced, right? So do you have a car right now? If you have a car, maybe the car is not running that well. Maybe you use that $1,000 to make sure your car is running well so you can get back and forth to where you're gonna be making more money. Now you're making more money, now you're putting more money in the bank. You're putting more money in the bank that's earning a high interest rate. Now you're making more money that's growing passively for you. But before you saved that money, you didn't have that $1,000 to fix your car. Your car is still sitting somewhere with grass growing under it, and you're still not moving. You see my point? So we have to get our thinking right before we can start growing. And the first thing that we do is we need to understand how money works and how that money can work for you. Where can you put your money right now for the goal that you have right now? And once you achieve that goal, what do you do with the money that you earn from that achievement? Do you continue to grow or do you stagnate? And then there's an opportunity, you know, I heard a crazy line in a movie last night, more yellow ones. Are you doing this to tease me? More yellow ones?
It's in the bag.
Okay.
Put them up for people to sit on.
I saw this movie with, what's his name, Brad Pitt, that racing movie. I thought it was phenomenal, by the way.
Oh, yeah.
Sometimes when you lose, you win. Sometimes when you lose, you win. So again, I'm sitting on my mother's couch. My mother's yelling and screaming at me, get your ass up. Sorry, y'all grown men around said, no disrespect, Colin. Get your ass up, get your ass up. I don't want to live under that anymore. I don't want to be that uncomfortable anymore. This is a long time ago, but I was a grown ass man. I don't want to be listening to my mom telling me to get my ass up, right? I don't want to be in that position again. So if you don't want to be in this position where you are, take advantage of this opportunity to learn. Because what ends up happening is you'll see the contrast in your life to where you were, because your story is not where you are. You understand that? Your story is where you're going. But if you don't know where you're going, you can never figure out how to get there, right? Facts. I want to go to Seattle, right? I know I need to go north. I want to go out of state. Well, there's a lot of states. Which way you want to go, right? Because if you go west from where you are, if we go west from where we are right now, what's going to happen to me if I'm walking? I'm going to drown, right? So you need to know where you're going. And then the next thing that's important is to make sure once you've identified where you are going, that you stay on course. Because the most important, you know, one of my favorite stories, a financial professional told me this story many years ago. You might have heard me say that in this class, so I'm going to tell you again, right? Does anybody know what a lumberjack is?
Sure.
All right, so you got this group of lumberjacks, right? These group of lumberjacks, they're big old, huge, husky guys, right? And they're going down here, and they've been sent out to go mow down all these trees. Big old, huge, husky guys, man. We're gonna go knock out some trees, right? So they go out there, and they're just cutting these trees, and they're cutting these trees, and they're cutting these trees, and they're cutting these trees, right? Well, the foreman, he goes out, and he notices, where are all my lumberjacks? He's looking for the lumberjacks. He can't find them. Where are the lumberjacks at? So he goes, you know what? I need to figure out where these guys are. So the guy climbs up to the top of this big old tower to look for where his lumberjacks are. And he finds them. And he freaking freaks out. Like, and he's yelling at them, guys! Guys, they're working, they're knocking trees down, knocking trees down. Guys, they're working, they're knocking trees down, they're knocking trees down. Guys, and they turn around, what? The foreman says, what the hell are you doing? He says, what are you talking about? The foreman says, you're going the wrong way. And the guys say, yeah, but we're making good time. So they're going the wrong way fast. And the one thing about going the wrong way is life is about keep up, not catch up. So if you're going the wrong way, it takes you that much longer to get caught up. So in order for you to get caught up financially, you have to put your money in accounts that's going to help you go faster. A savings account or any account that does not allow you to earn your money that outpaces inflation is you going the wrong way. You might be a big, huge, husky guy, but if I hired you to go west, you're going to drown. I live in Los Angeles, by the way. Going west would be going to the ocean, right? If you're on the East Coast, then going west would be fine, right? But the bottom line is we want to make sure we put you on the right track. The reason why we are here is because somewhere along the line, we fell off the track. When I was living on my mother's couch, I fell off the track. I'm making 6 figures one year, and now I'm sleeping on my mother's couch the next year. I fell off the track. But the goal is to take that opportunity to figure out where I am so I can get myself back on track. Now, keep in mind, my life kept going even if I wasn't there to enjoy it. That's going to sink in after a while. My life kept going even if I wasn't there to enjoy it. So I need to get back on track to catch up to the life I'm supposed to have. But in order for me to get caught up, I have to use tools that's going to help me get there. The purpose of this class, the purpose of me offering my services, this is free. Y'all veterans, most of you, right? I want you to get the information so you can get the speed that you need to get caught up to the life that you're supposed to have. You're just off track right now. But once you get back on track, the one thing about the fastest race car in the world, do you know the fastest race car in the world is nothing if the race is over? Your race is not over yet. And as long as your race is not over yet, you have a chance to get caught up to the life you're supposed to have. My job is to give you the tools and the information that you need to do so. Your job is to use them. So when I tell you about checking accounts, when I tell you about savings accounts, ETFs, mutual funds, stocks, bonds, all this other stuff, taxation, budgeting, all that information is to help you get the tools that you need so you can get caught up to the life that you're supposed to have. Right now, you're just in transition. And hear me when I tell you, I'm older than everybody in this room except maybe one of us. Okay, 2. Okay, 3. Okay, I'm in the middle. But the bottom line is I've had a lot of life. I've had a lot of good life. I've had a lot of uncomfortable events. There's no such thing as a bad life, it's just life, right? But there are events that I would prefer to have been better. It's facts, okay? In order for you to enjoy more of the good events, we have to make better decisions so we can enjoy those good events. And in order for us to make better decisions, we have to have better information. I am here to give you the information that you need, at least in the financial realm, to be able to help you with whatever you're looking for. That's my email address right there, info@warfieldlegacy.com. Now, I'm talking to men, right?
Yes, sir.
So I'm gonna tell you straight out. This information is available to you, but I'm not knocking on your door to give it to you. This information is available to you. I'm not chasing you to give it to you. I come here every month because if you show up, you show up. If you don't, you don't. If you leave, if you stay, it's no never mind to me. I got saved in October of 2021. This is my ministry. I told God I'm gonna do this till I freaking drop. But I'm only gonna do it for the people that's willing to sit up in here and listen. There is no question that you have that I will not get you an answer for. If I don't know it right off the top of my head, I guarantee you I'm gonna get that answer. It's your job to do something with it. Because here I'm just gonna be real with you, okay? I had a blessing of having a mother that got on my damn nerves. she made me get off that couch, man. I had some incentive. Not a lot of us have that, and I appreciate that, right? Not a lot of us have that tough love that's gonna force us to move from where we are to where we need to be, okay? I'm not your mama, I'm not your daddy, but I am your friend. And I'm telling you to your face, if you wanna learn it, I will teach you for free, fast. I don't want a cent from you. Maybe more of these yellow starbursts, but outside of that, I don't want a cent from you. The only thing that I do want from you is if I'm gonna take the time to teach this information to you, I need you to use it and do better. I wanna be able to see every one of you in a better situation the next time I see you. Even if that better situation is, Tony, I opened up a high yield checking account. Tony, I got myself a CD, right? Tony, I learned more about compounding interest. Tony, I got all three of my things. I got some money in my pocket. I got the money in the bank. It's making me some money. Tony, I got enough money to be able to negotiate the interest rate that I'm getting for my money. If you grew from the last time you and I spoke, that makes this time worth it to me. And it's worth it to me anyway, because I feel like I'm doing something that's benefiting some people, right? I don't care where you are today, because where you are today is not your life. It's just a way station from where you're supposed to be. Again, my job is to help you get back on track so you can get caught up to the life that you're supposed to have. Whatever that life is, I don't care what it is, as long as it's legal and doesn't break man's laws and God's laws. I have to say that, right? Because we don't want anybody out there. Well, I want to be the best thief ever, right? Well, that's the United States. I'm sorry, I didn't say that on camera, did I? I'm an American. I've been to 2 wars. I can say what the hell I want. Thank you. Right? Right? So does anybody have any questions on that? What's a burning question that you might have about your financial situation? There's nothing taboo. Burning question. Anybody got guts? Who wants to share? Come on, Lightning. You look like you got something to say.
I was thinking about like maybe realistically, what would be a minimum amount of money one can have to maybe start stocks and bonds, right? Like, can I be doing it at $50 if I got something like that?
The answer is yes, because you got over-the-counter stocks and you got penny stocks. You saw those blue chips that they were talking about.
Yeah.
But the first thing that you got to ask yourself, and I appreciate the question, but the first thing that you got to ask yourself is, can you afford losing that money?
Yeah.
Because if the answer to that is no, you should not be messing with stocks. Go with a mutual fund, because you have that money spread around more, right? It's still the stock market, but spread around. You have bonds, that's guaranteed return, certificate deposit, guaranteed return, high-end, high-yield savings account, guaranteed return. But when you start putting your money in the stock market, the one thing about the stock market, and you know what? I'm so glad you asked that question, because it's the one thing that people they forget to tell you about when it comes to the stock market. If you are not the person managing your account and someone else is managing your money and they're doing multiple trades a day, a lot of the money that you would have been earning gets eaten up by fees. So a lot of the returns that you would have had, you don't get, right? Now, the one thing about a mutual fund that I don't like, Fallon, this is for you too because of where you work. One of the things about a mutual fund that I don't like, whether you have a 401k, 403b, how long time?
5 minutes.
Okay, 401k, 403b, 457, TSP, SEP IRA, standard IRA, anything where a company is offering to pay money into your account. Whenever that money is going into that account, that money is going into a mutual fund. Most of the time, the companies are using mutual funds that benefit who the most?
Them.
Who said that? Them. What does that mean? That means that the money is spread out. You'll see your money spread out to as many as 20 different funds. Okay, but you'll see very small percentage returns if you see returns at all. But over time, the stock market itself, because you're investing in the stock market, over time that money grows. But if you have 20 different mutual funds and money is moving back and forth, and fees are being charged every time that money is being moved, how does that affect the growth of your money? So this is what's interesting about that. You might hear an employer offer you a company match, right? If the company offers you a match, 1, 2, 3, 4, 5, 6%, how much money did you invest of your money? Say the company is matching 6%. How much do you match?
6%.
6%. Why?
They're matching funds, you're,
100% return, man.
okay.
100% return. But do you invest 10% of your money?
No,
Why?
because it's too much of a risk.
It's too much of a risk. Next time you teach it, you know that.
No.
Okay, so it's too much of a risk because that 10% is all your money. It's not backed, right? So if the market crashes, say the market crashes, and they're matching you 6%. Say the market goes down 50%. What really did you lose? You lost whatever they were giving you, but you still got your money, right? Is that okay? But say you put 10% in there and the market went down 50%, you just lost some of your money. Now, if you're 20 years young, you got time. But say you're about to retire in 3 years. A 50% loss is devastating to someone that's getting ready to retire in 3 years. That means they cannot retire in 3 years. Because let me tell you what happens with your retirement funds. They still have to be taxed. That's another conversation. Okay? So again, whether you're working, whether you have a retirement plan, whether you are service connected, if you have an income and you have money left over the month, what are you doing with that money? The best thing that you can do to identify what to do with that money is to identify a goal that you want. What do you want to do? Okay? For example, if you find yourself struggling every month to get money for something that you want to do, or every other month or every 6 months or whatever, that means it's time to start reallocating. We talked about that. If you got that money saved up or you don't need that money for a period of time, let's start putting that money into a higher yielding account. If that money can be put away for a couple of years and you don't need it, let's start putting that money into an account that you don't have access to. If that money can be lost and it doesn't hurt you financially, now let's start looking at stocks. How much money is that though? Okay, can you afford to lose $50 a month? If you can afford to lose $50 a month, then yes, you should start investing in some kind of a stock.
Are penny stocks the best way to dabble in the market for a beginner?
I think that any stock is the best, any stock that you can afford is the best way to start in the market. Now, there's a caveat to that. Are you paying attention to it?
Because you may want to get out of it and switch.
Man, I don't know what happened there, but okay, so my story I'm going to share. I was a day trader back in 2000. I was a good one. I made more money in a couple of days than most people make in a year. Okay, but again, I was good at making money.
With somebody else.
Yeah, no, it was mine, but I wasn't good at protecting it. So when you're a day trader, you have two types of orders, right? To sell. You have a 24-hour stop order and a permanent stop order, right? 24-hour stop order and a permanent stop order. So let's say the stock is $50, right? And it's trending upward. Great. I'm a day trader, so that means I'm watching what the stock is doing every day. So as a day trader, I'm watching what the stock is doing every day, but I decide I want to take a vacation, right? All right, so the stock is doing 50%, it's trending upward. I'm feeling pretty comfortable. I'm gonna be gone for a couple of weeks. I'm gonna go ahead and put a stop order on it. Tell me what's a stop order? I can handle a 10% loss. So I'm gonna set my stop order for $45. That means that if the market goes up and then drops and the price is $45, I want you to sell. Automatically, I don't need to be there. I can go on vacation, Cancun, wherever, chilling, right? Now I can have that as a permanent stop for the 2 weeks, or I can have it set as a 24-hour stop to where I'm only going to be gone for a day. I'm not going to be in front of my computer. If it drops to $45, sell it. If it doesn't, leave it alone. So I met this really, you know, every good story has a woman involved. You know that, right? So I met this young lady, beautiful. I decided I want to go on a vacation for 2 weeks. I was so used to using a 24-hour stop order and I used a 24-hour stop order when I should have used a permanent stop order. When I went on this vacation with this young lady, I was completely unplugged. When I came back, half my money was gone. Because the stop order expired, and what was $71 a share was now down in the 30s after 2 weeks. And if I told you how much money I lost during that 2 weeks, and this is the same 6-month period where 2 of my businesses failed because we didn't get enough funding, and I lost my job. That was a lot of fun.
That's how you end up on Mama's.
That's how I ended up on Mama's couch. Now, again, I knew how to make the money, but I didn't know how to protect it. Had I put my money in the right stop order, had I not leveraged myself so much in the stock market, and I had more other things like those bonds, that's why I'm teaching this to you, because it's something that I did not learn myself, and it ended up putting me on my mother's couch.
So what about day trading? You don't
Day-
trade anymore?
I don't do it anymore because I find now that I'm older, I still recommend it to people that want to do it. But if you have that time, I don't have the time because I do a lot of this. But day trading is a full-time gig. You understand that? You're in front of that computer all damn day. I don't do that. I got grandkids now, bro. I ain't doing that, right? So I'm a life insurance strategist because annuities pay better. That's another conversation. But no more day trading. I just don't have the time for it. But I still recommend it for people who have the time. So when you see those online trading classes, take it. At least understand how to manage your own money, because the more of your own money that you manage, the less fees that you pay for someone else to do that. And the more money that you have in your account earning compounding interest, the sooner you get to your financial goal. So again, before you leave, because I think that's my time, before you leave, I need you to figure out what your financial goal is. Grab a pen, piece of paper, do whatever. I'm sorry. That lady left. I meant to get her contact information. I need to think. Take one down and pass it around. It should get over there. So again, whatever question you have, I'm happy to answer it. But use the information that I give you to make yourself better. Figure out what goal whatever financial goal you might have. And if I can help you get there, I'm happy to do it. All right? Anybody want to volunteer a financial goal before we leave?
I'll be able to invest $1,200 a month.
You want to be able to invest $1,200 a month?
Yeah.
Are you willing to do what it takes to get there? Send me an email. Dead serious. All right? Thank you all so much for your time.
That was good.
Thank you. Thank you very much. All right. Merry Christmas, Happy New Year, Kwanzaa, Hanukkah. I don't know all of them.
So did you
L'chaim.
piss off your training officer, and that's how you ended up this year?
Anybody want more cookies and Starburst?
Flight engineer, so yeah.
Did you go once a year or East Coast?
I was somewhere on the border.
Oh,
Thanks, everyone.
I'm that guy.
I'm sorry, I didn't.
You're-
It's fine.
I was
Some of them
more
have
about
ones like
Water
this.
Spring.
Some have like a little-
Thank you. All right with me. What's your name, sir?
Mitchell.
Mitchell. Thank you so much for the participation.
Thank you for the class, that was
Yeah.
great.
Don't take the yellow one, don't mind.
You better stop. It's a whole bag of them.
I already took so many of them already. I don't need any more. Lightning, you're awesome, bro. I hope I see you
Well,
next time.
thank this class, I really needed it. Thank you for doing this.
Yeah. Grab that email address. Send me whatever questions you
Third Friday of
want.
every month. Third Friday of every month is this class.
I think I like the video. Oh, I'm sorry. Thank you all so much. If you're on, appreciate it. See you guys next time. Thank you, American College. Thank you, my viewers, and thank you, veterans. I salute you all. God bless. And you know, I never figure out how to stop this thing.
What?
Still don't know how to stop this thing.
I'm gonna put the,
How do I stop it? Okay. I guess I'll leave it alone.
Yeah.
What happened?
Really? What's that?
Sunflower seeds?
It has its own
Yeah.
distinct taste, right?
How do you stop it?
We can change it.
Thank you so much, baby.
Thank you, Mr. Greg.
All right.
I gotta have to pay off some tickets for, I didn't want to pay it, so I was like, sorry.
That makes sense. No money is yours, bro.
Oh, yeah.
All right, do me a favor, shoot me an email.
We want to change your mind.
If you don't mind.
I just don't wanna,
Probably the first week of January.
So right now, I'm trying to.
I'm trying to see if I'm coming for maybe, I might come to last, of this year, but I gotta see how my son's school schedule.
and this was,
I'm interested in.
Maybe we'll take mine.
It's just so that this makes it free, bro. I can-
Look like it's Mary's time.
Yeah, it does, it does.
These boxes you don't need?
The two.
Okay, you have more?
Yeah, you're right, Nate. Yeah. 22 years.
And I still don't know how to stop this thing, I don't know.
Yeah, all marine units except for the Sierra sign.
The Sears, is this thing even recording right now?
So you were,
I was in
green side,
Yeah, I was on the marine side the whole time.
right on,
The Marine side?
Well, I was Navy foreman, medic,
yeah.
Oh, were you?
They call, yeah, they call some of those guys
doc.
green side, yeah.
Yeah, green side foreman.
Blue side or green side.
How much of a corny dude am I that I don't even know how to stop this thing? I don't know. I'm not that old. I guess I'm that old. It won't let me do it. It's supposed to be able to.
Android, so it's even more.
Oh, are you sure you want to?
Might need to
Why you
just
making me
shut
look
it
bad?
down.
It's the one button. You got the rubber band.
So what, she found it for me.
It's the rubber band that's blocking it.
It's okay.
Jeez.